Greetings, folks. You've reached DC Investing. I've reached financial independence, and I want to talk about topics that may help others also become financially free. Today's topic that I wanted to mention was a tax hack that you can use if you have a potential IRS penalty for underpayment of taxes. So, what that means is the IRS typically wants their money at least 4 times a year because they're broke, they're living paycheck to paycheck, and so it's not good enough for you to just pay your taxes once in a year. No, they want it all throughout the year so they have money to live on. And so how that can hit an investor is you might be watching through the year, and at the end of the year in December, you decide to sell a stock. Well, you get a capital gain with that. That capital gain, if you hold it for less than a year, is a short-term capital gain. You pay ordinary income tax on it. Or if you held longer than a year, it's long-term capital gains, which is tax favorable. But it does stack on top of W-2 income. So, if you have a decent job and you're working and you're withholding money from your paycheck, everything looks fine. And then suddenly at the end of the year, you sell a stock. Well, you're going to owe more taxes on that. And the IRS wants you to have submitted equal payments throughout the year quarterly. And if you didn't, they can add a penalty to you. Now, there is a form that you can fill out that says, hey, I sold this at the end of the year. And I think in theory that kind of helps you with that. But you got to go find that form and figure out how to file it out right, or give it to your tax accountant or whatever. And it's just a hassle. So something I learned, and I learned this from a channel, I think it was called Safeguard Wealth Management, and it's got a different name now, but kudos to them for teaching this, is what happens if, here's a way to not pay the penalty by using a strategy that exists within the IRS tax code. And if the way to do this is if you have an extra gain, could be you've got more dividends than you planned on, you got a capital gain, or maybe you just set your withholdings from your normal job down a bit lower, so you got to use your funds all throughout the year, but you actually owe a little bit more in tax. And this only works if you have an IRA, and you've got funds in the IRA enough to do this strategy. But basically, you can call up your broker. I guess this might not work as well with something like Robinhood because they don't have as many folks you can contact. I haven't tried it with them, but I use Fidelity. I call Fidelity up and ask them to do this, and they've got great customer service. So no worries, no problems with this. Some of the other brokers, you might be hit and miss with it. I'm not sure. But basically, you're going to make a distribution from your IRA, and there's a few steps to this. And when you take this distribution from the IRS or from the IRA, you're going to set your withholdings to 100%. Now, normally the default is something like 10%, and what this is set up is for retirees who are living off their money. They pull money out of their IRA. They do owe taxes on it, and so you set the withholding to like 10% to cover your taxes, then you take the rest of it. But this strategy, you set the withholdings to 100%. So all of the distribution is going to your taxes. And when I've done this, it's like late in December, I'm looking at my tax bill that's coming up in April. I'm like, I'm going to get a penalty if I don't do this. So I will take a piece of my IRA and I will do a 100% withdrawal, and it all goes towards tax. And then in April, I get a form for this and it says, yeah, you withdrew this amount. It's all tax. It just adds as one more form on your taxes. And that helps save your penalty for underpayment of taxes. Now, there's one more step to this that you have to do, because taking a withdrawal from an IRA counts as a distribution, and if you're below age 59 and a half, you get a 10% penalty from that. You also have to pay taxes, so that's no good. So here's the thing that you use is there's an IRS rule that states if you refill your IRA within it's either a 60-day or 90-day period, I can't remember which it is, but it counts as a rollover. And so what that rule was meant for was folks who are just moving IRA funds from one company to another. You can pull funds out of an IRA and then move it within a 60-day period to another location. You can also do like a little quick loan to yourself. If you need funds over 60 days, you can pull money out of your IRA. And as long as you put money back into the IRA within 60 days, then there's no penalty to do so. So we use that for this tax purpose. So you pull a distribution from your IRA, 100% withholding, and then within a short time period, you have 60 days to do it, but usually just get it done. You put the same amount of money transferred from your brokerage back into the IRA. So this does a few things. Number one, you have now withheld taxes to pay in your April timeframe. And what's interesting is because this money was withholdings, it's not an estimated tax payment, it's actually withholdings. The IRS considers it as if you made equal payments all throughout the year and everything is good. So let's say you had a big capital gain at the end of a year, you might have a $100,000 gain. Well, that's a big tax bill. Well, if you have enough to pay the tax in an IRA, let's say you had a $15,000 tax bill on that, you take $15,000 out of your IRA, withhold 100% of it. That goes to the IRS. It counts in April as withholding, just like withholding on your paycheck, or if you'd made, estimated payments, it all works out there. And then, a day later or 2 days later or even a month later, you go back and you put that $15,000 back into the IRA, and you have to tell your brokerage that this is a rollover deposit. It's not just a contribution. This is a rollover deposit. Then everything works out. You get to pay your taxes. It doesn't count as a distribution. And it's kind of like this get out of jail free card. So I've used this a couple times. One caveat is you can only do this strategy once a year, once in a 365-day period from your account. And so, you could start on December 1st one year, do the strategy next year, do it on December 2nd, next year, December 3rd, December 4th. So you can kind of stack it that way. But if you have an IRA with your spouse, you could do one distribution from your IRA one year, and then the next year take it from your spouse's IRA and then shift back and forth. And so those are kind of the strategies that are there. But this is a way to avoid penalties for underpayment of taxes, and it's a very interesting strategy that, again, I learned by watching YouTube videos. So hopefully you can learn this too. If you want more information, I'm not a tax advisor, but look up online about 100% withholding, then IRA rollover. If you search around, you'll find the strategy on the internet. It is within our tax code system, something that you can use. And so hopefully this helps someone out there. An interesting strategy. Check it out, and it can save you big on tax penalties. So let me know if you've ever heard of this before, if you've used this strategy, if it was interesting to you, or if you have other ideas too. Comment down below, like, subscribe. Thanks a bunch for visiting DC Investing.